All right, it's 1 minute after 7. I'm going to go ahead and get started. We've got some thunderstorms rolling in, so that's played havoc in the past with the internet connection, so I want to make sure we get as much in as we can. Thanks for the nice comments. The girls have been really playing well. We had another league game today. We won 4-2 against the second place team, which guarantees us our win for the league championship too. So pretty happy with the way they're playing. They got one more big tournament coming up next weekend, and waiting to see if we get accepted for a regional tournament. I'd be surprised if we do, because it's coming from an 8-team or an 8-state region. But you never know. We put in our application. We'll see how it works. All right, let's just go ahead and get started. This is the weekend report for May 4th, 2012. Still in bullish normal conditions. 57 out of 100 on the annual. Based on weekly RSI 14. We are oversold on a 10-day NDX. This should read oversold, not overbought. I must have been brain dead Friday night. So we are actually oversold on a 10-day basis. The percent stretch above the 200-day moving average is back into the white. It's only at 7.98%. Which is still bullish, but it's weaker than it has been. This is the second time that it's dipped down into white status this year, and that's an indication of a weakening bull. It's because we've had two significant pullbacks now. Slope of the 50 is yellow. It's positive, which is good, but it's in the yellow means it's below average compared to the last 180 days at only 0.21, so I rate that as neutral. ADX is at 15.3. It's come a long way down since approaching the 40s, as we saw a couple months ago, and so that's a neutral strength of trend, which favors short-term traders and being able to take the middle out of the channel, or the middle out of the reversion to the mean trade. ATR percentage is still normal at 1.12%. The 26 ETF and 13 ETF portfolios are holding as you see. Next reevaluation on or about 1 June. In ETF2, the theoretical model is at 40% because only 4 of the 10 main indices in the world market model are above their 4-month moving average. The model portfolio itself will be at 80% exposed. It is selling one position in IJS, which is a U.S. small cap, and selling that on Monday. Moving on. As of Friday, the 13 ETFs in the 13 ETF portfolio, those showing you the top to bottom. It's still U.S. heavy, but you can see treasuries have started to move their way back up as a consequence of the weakening in the market. It's gone from last place to about high middle. But it's still the U.S. favored over the rest of the world. In the 26 ETF portfolio, the same story holds true. It's the U.S. With the addition of XLF, the financial sector spider. See, emerging market bonds, this EMB is still high in the list. Everything at the bottom is kind of the internationals and the emerging markets, as you can see. Even gold is down low, although it is higher than it has been. It's I think postured for another run here if we get some weakness in the equity markets. I think both gold and silver are at support levels. Next up is the market health check. The vertical blue lines represent 10, 20, and 30-day look-back periods. The horizontal thick purple line here at 142 represents the swing high from about March 26 when it hit 142, and again early in April, 1st of April, hit 142. The horizontal red lines represent two key support levels at 136 and at about 134 that have held as important support before. We're getting ready to test that here pretty soon. The two red rectangles represent a 5% sell-off from the swing high, which would put us right at 135. So I see that as a support level. Pullbacks of 0 to 5% are considered to be market noise. Between 5 and 10% would be a correction in a bull market, so that would take us all the way down to about 128, which is even off the chart here. The horizontal black line, or actually the middle black line, is the 30-day regression line, offset by 1 day. And then the outer black lines represent the 30-day regression channel formed by the maximum excursion from the regression line during the look-back period. And that happened about 10 April, where you see now, and that's why the channel is as wide as it is. I've used Andrew's pitchfork to project forward that regression channel. So whatever it is that's driving this market right now, if nothing fundamentally changes, we would expect price to sort of conform to this downward glide path right here. You can see the regression line had rolled over, and price has pulled back after being not quite able to get back to 142. So we actually have a swing high at 142, a sell-off, and then it couldn't quite make 142. It only made like 141.5, and is now rolling over again. So that's not good. You see ADX is down to 15. It was up almost to 40, and it has declined steadily. And right now, based on the selling action on Friday, the bears are in charge with 2 sharp days of selling in a row. That has put price now in the middle of the lower half of that regression channel and getting ready to test 136 and then really 135. To me, 135 is really a key price level. That if it fails at 135, the next one is 128, and and it will be definitely into correction zone. This is actually a good place for bulls to be looking at the short-term swing trades here on the long side, rewarding the pullbacks in a bull. Yes, it's the strength of the bull is decaying, but it's still there still is an upward bias, and so buying dips is indicated in bulls. We're still quite a distance away from the 200 period moving average at 127. That would be the boundary of the bull market. You see Williams %R has rolled over from overbought now to oversold, so the channeling signal is in effect for SPY. The percent price oscillator has closed its jaws after this minor run-up. What you'll notice is that the length of time that it was in decline was 20 days, and it only lasted about 6 or 7 days on the upside. And that was reversed during this long run-up from the start of the year that got back to 142. The jaws of PPO were open to the upside a lot longer than on the pullback. So this is just more evidence of the market weakening. The slope has rolled over just below the 0 line, so slope is negative and getting weaker. You can see the 10-period moving average is rolling over as well. We violated the 50, so what we have now is price is less than the 50, is less than the 10 in the bottom half of the regression channel. If it finds support at 136, this creates a nice trading range from 136 to 142. but as it stands right now, we've got some weakness. The wiggle room right now is between about 137 and 135. There's only about just around 2% before this starts becoming a concern to institutional money. So in my view, the short-term traders are favored right now. I think it's wise to gather the profits you can intraday rather than holding out overnight. I would be more willing to take the bird in the hand than holding out for two in the bush right now. Aging bull, and so that's where I think we are right now. Now I've added the river to the daily, and that's the river is what we call a 30-period Bollinger Band plus or minus 1 standard deviation, and that should hold about just a little over 2/3 of the price action of the last 30 days. And you can see that during the long bull run, the Bollinger Band mean, which is the dotted line, was generally up until it made this double top over here at 142, and then has been weakening since then. And that weakening of the last 2 weeks has been enough to cause the Bollinger Band mean to flatten out, and we were barely able to get out of the river on the upside this week, and now we violated to the downside, and that's why I see this as a pretty important turning point. This is the second significant pullback from the 142, and it couldn't make a new high, and it's leaving the river to the downside, and the river is going sideways, and the regression line is pointing down, and 135 is the boundary of noise. So I think we're right on the edge of this bull being officially over, in my view, and getting back towards sideways and channeling. So be cautious with your positions. This is one where I'm more inclined to take profit rather than letting it run. I want to respect all my stops and play the cards close to the vest on this one. This is a tough market right now. Favors the intraday and the short-term trader. Okay, moving on. Oh, just good. Lisa asked a question, how is the regression line calculated? It's just a straight regression line of price. You can do it in Excel, or it's calculated. Stock Charts has has a little drawing tool on it that allows you to draw the straight regression line for any look-back period. I just happen to have this one set at 30 days with a 1-day offset. Excel will do it with the regression function. And I can show you that later. But yeah, in Stock Charts they have a little regression channel tool. Okay, moving on. Next up is the top 10 ETFs of the world market model. And we have 6 that are on a cash signal and only 4 that are on a buy. It's interesting to note that this is the first crack in the U.S. market here, the IWM being on a cash. The other 3 U.S. indexes are on a buy, but now even the small caps in the U.S. are on a cash. And that's really starting to become more risk off because they're more speculative than the large caps and that more of a trader's vehicle. And so that's the first one that you would expect to crack when market psychology changes, and that's what I think we're seeing here. So we've gone to 40% invested, 60% cash in the theoretical model, and that just simply reflects the general weakness in the globals and the weakness that's starting to creep into the U.S. SPY is still better than EFA, with 67 being better than 57. And inside the U.S., it's the techs, then the large, then the mid, then the small. Techs and the large being the 2 strongest, Japan and Latin America being the 2 weakest. So this is really the intermediate term giving us warnings as well about a potential change in the market psychology. Moving on. Looking at the world market model next. And we have most of the U.S. is above average, but you'll see weakness now in small cap, value, and blend. Technology is strong. U.S. real estate in the green. Treasuries and corporate bonds have gone to above average now as part of this risk-off trade. Gold and silver still lagging. Broad weakness in the commodities and oil. All of Asia and Asia less Japan and Japan are weak. All of Europe weak except for the growth sector. I think that's a reflection of strength in tech. The winners in Asia remain Hong Kong, Malaysia, Singapore. The laggards have been weak all year. That's China and India. Latin America weak, exceptionally weak. Emerging markets weak. Only Mexico and the Western Hemisphere is keeping up with the U.S. But yeah, you can just see the weakness creeping back into equities when even the U.S. sectors are starting to fall below average. In the business sectors, consumer staples, that's going to be your XLPs. That's XLP. That's your McDonald's, Johnson & Johnson, Coca-Cola, Pfizer have gone back into the green. Weakness coming into global tech, and starting to see weakness now in financials and industrial, starting in the world first, but the weakness now moving to the U.S. Energy and materials showing weakness. Healthcare coming back strong. So this is really starting to see a shift now to that risk-off trade with the mature large cap companies starting to receive some of that money and some of that speculative money coming out of emerging markets and small caps and moving towards the relative safety of large caps. So I think that's what we're seeing here. Looking at the top ETFs from the ETF2 database. Home construction, retailers, bonds, retail bonds, more bonds, the biotechs, retail, consumer discretionary, XLY, that's still interesting to me. And here's XLP, that's that consumer staples select spider. I think that's the one that's likely to continue to gain if we have weakness in the risk on categories. That's the next natural place for money to go to in terms of sector cycling. Technology has fallen off. It was a top 5 for a while, but now you can see that the Qs and even XLK, which is the tech sector spider, have fallen out of the top 10. Still green overall, but you can see that they're starting to get weaker. Moving on now to the Dow 30, using the same general sorting and calculating strategy. Home Depot, American Express, now Coke has moved back into the top 5. JP Morgan and Disney, Travelers, Pfizer. So I mean, I think that's where you're seeing the strength in the that comes to the XLPs. Coca-Cola, Disney, Pfizer, Merck, all in the upper half. Those should continue to do well. See, one of the things you can see in Coke is starting to gain some momentum is that it's an 82 on its strength and only an 80 in a white on the consistency, and that means that the shorter term strength is outrunning its 10-period moving average, and that's why it's green on strength and only white on consistency. So that's a sign of acceleration in Coca-Cola, and that would also be the case for this stack right here: Travelers, AT&T, Intel, Verizon, and Pfizer. Yeah. And now, conversely, when you see it's green on consistency, but then white on strength, like Bank of America, that's a sign of the shorter term relative strength decaying compared to its long run up. So Bank of America was one of the top 2 or 3 for the last 2 months, but now you can see it's starting to weaken. And interestingly, it even hit it's below its 4-month moving average. So that to me suggests that the easy money in financials is over, and we're looking more towards the staples. That's how I am interpreting that. Nothing really new to report in the volatility study. Still been exceptionally low, and that has always been the case of prior to these huge spikes up. I think we see a big spike up in volatility if price cannot hold above 135. It's trading at 137 right now. If it breaks below 135, I think we see a little short-term repositioning and selling. And then I think we'd see volatility spike up and catch people by surprise again. And that's what we're going to take a look at VXX here after we get through the daily, and just to show what I think is happening in the world of volatility. Okay, we're going to shift gears now over to the daily report. Let me call that one up. Okay. All right, let's see. So we should have the daily up for you now. There we go. Okay, so I'm not going to review the top row. We've already seen that once before. We'll just go right to the overreaction system is firing on 6 signals and another 7 signals out of channeling. And I think, again, that doesn't mean we have 13 most excellent trades. I think once you get past 4, as I've said before, I think what we have is the market is in that kind of condition now. The sudden system shock of the selling of the last 2 days is could be considered an overreaction, and it also was a deep enough sell-off that it triggered channeling for most of the global indexes. You can see volatility is right at the midpoint, the median of the last 6 months. And ADX has continued to decline with now the bears in charge. 10-day max pains, you see the weakness now in Bank of America, Caterpillar, Alcoa, Walmart, and Microsoft. That's Russia, the VIX, oil and gas exploration, oil and oil service. So energy has been a big loser. That may be a potential for a reversion to the mean trade on a rebound. So that's one for the intraday traders to be concerned with. In both the ETFs and in the large caps, you have a ton of channeling and overreaction signals. 5 days down, you got Japan and Pfizer. Triple Screen has Pfizer. And in the auto framer, there's also a ton of symbols that frame out at better than 2 to 1. And we'll see some of those here in a second. We're looking at the Dow Tactical next. And I just want to draw your attention to a new column that I've added. The guys in the chat room, Mark McDowell and the gang, and Hunter and Robert Gardner, have all been having some good success with the use of the RSI-2 reading. That I think they use it when it's under 10. So what I have in this column is when RSI-2 is under 10, it will flag as a green signal, as perhaps a short-term overreact. It's like a proxy for short-term oversold. You know, it was 2 days of horrible selling and a close near the low of the last 2 days is normally enough to cause that to go under 10. And so that's Connors has shown some research which suggests that's an interesting moment to start stalking the entries. You can see now we've got only a couple of dojis in Kraft and Travelers, and then a lot of channeling and overreaction signals. Pfizer has both the 5-day down and triple screen. Pfizer is one that to me should be very interesting to you. It was not a horrible sell-off over the last 2 days. It's actually it only lost less than 1%, and so it's been relatively untouched by the selling, which I think had a lot to do with technology and risk on trade being liquidated. So Pfizer's got channeling, overreaction, 5-day down and triple screen, and an RSI2 of 2. So that suggests to me that there's some value available in Pfizer for intraday trading. Okay, you can see the Walmart is auto frames out at 5.4 to 1. Microsoft, Bank of America, Caterpillar, Procter & Gamble should be one that's of interest. You see strength. It was actually a % winner on Friday. It only lost 0.4%, which puts it in the green. And so it was very resistant to the sell-off. If you look at the names that were selling off, they were former leader. Microsoft, Bank of America, Cisco, JP Morgan, and Intel. So that's tech and financials, which have led the way up. And the things that resisted that sell-off tend to be these value companies, the consumer staples. So that, to me, makes Procter & Gamble interesting on a 3.8 to 1 reward to risk ratio. So that's one that bears watching. Next one up, the ETF 30 tactical summary. This one also features the addition of that RSI2. And again, you could just see how many of them sold off over the last couple days and are now flagged on the RSI2. Only one doji in natural gas, a ton of channeling and overreaction signals. Japan's on a 5-day down, and then a lot of commodities in here. You get Brazil with its commodity-based economy, oil, silver, and coal, and then the VIX flashing the signal here as well. And when the VIX closes at 91 on the RSI2, that's a sign it closed near the top of its range. Again, a lot of things test out on the auto framer at greater than 2 to 1. That's why they're showing in the green. So really, any of these max pain range compressions are all testing out favorably. You can either go for, if you're interested in oil because it sold off so harshly on Friday, or you could say, hey, silver and the VIX, or silver especially, had strength and still frames out at 2.3 to 1. So that's an interesting one. Moving on. Looking at the market mosaic indicators, the regression line is rolled over. You see we're now below the regression line. It had crossed above its 10-period moving average and is getting ready to fail to the downside again. So that would be all part of this narrative of selling off. If it breaks down much more, let's say if the scenario to me is 135 in SPY. If 135 doesn't hold, then you'll see this regression line get ugly in a hurry, and then it will be into new downward territory that we haven't seen for 6 months. It will have been a failure at the 10% stretch above the 200-day moving average, and then the next stop would be the 200-day moving average, and that represents almost 7 or 8% additional selling. So we have a market that is it's aging bull, and the downside is starting to get serious. I'm going to flash through the reference deck. We'll just take a look at the holding X day period. See what we can see. Looking at, I want to look at 10 days because we've had about 10 days worth of selling. You can see all the Z scores are in negative territory, except for U.S. real estate and Home Depot. So these are all ETFs except for Home Depot. What that says is this is broad-based selling, and because nothing is over 1.0 on the downside on the Z score, that says that we have just barely begun to touch the fear nerve right now. We have not really seen fear yet. On a 5-day basis, you can see that they're all up around 1.0 on the standard deviation. So that's still a normal amount of selling over 5 days historically. Has not yet begun to experience panic, and that's why I think if 135 fails, that would be the start of panic, in my view. And if we saw it fall below 135, I think the VIX would respond accordingly. Even in the safe zone channels, the next one I want to take a quick look at. Yeah, the elder safe zone is showing a violation of the downside part of the channel here. So we're right outside that's the indication of significant change in signal strength according to the trend. And we already know that, I think, from ADX, having gotten down around 15. And that simply says the next move can be a significant intermediate term move. Again, 2 to 3 weeks worth of a move in either direction. Could be supported before that trend got really strong. So this ADX is signaling a sideways chop right now, which is what we saw from the health check as well. That's everything I want to show on this one. I want to shift over now to just a quick look at the VIX. Let's see what we can do here. Yeah, so this week was actually a pretty good week to be doing some VIX trading, some volatility trading. And I just want to hit a couple highlights of that. So this was Friday, and I'm actually trading inside UVXY. That's the double VIX, for those of you that find the VIX too boring. UVXY, it's tradable, it's liquid, but like Mickey Redmond would say, it's no place for a nervous person. So what we had was on Friday, the market opened. This is UVXY opened. You can see the VWAP marching up. It came back through its VWAP and then went back up. I ended up buying it like 1385. Then the price continued. The 10-period regression line, which is the blue line, curved and went up. The 30-period regression line never even budged, and both were going up. And so with an entry around 1390-ish, by the time price gets up here to 1412, I've got about half an hour or an hour in hand, and it's just starting to uncoil and go. And then right next to it, I want you to see the simultaneous chart on SPY, that it gapped down, sold off, and broke through its own VWAP. Even the price never even got back above the VWAP and continued to fail. So by the time that I've got somewhere between half an hour and 3/4 of an hour in hand, and it's just starting to unfold to the upside, that's just the time when the S&P has tried 2 times to rebound and failed, and now it's made a new low of the day in a selling off. Remember, when all 3 of the lines come out of the river, that's the signal for the beginning of trending action. So really, it's the fail here at 138.21. When it failed below there, that's sort of an indication that we've got the beginnings of a downward move to make. And then I can take the high of the day, which was the open, add to it a negative range stat here, and then see what the downward target for a reasonable intraday move would be, and then use that to start estimating my reward to risk. You can see while all this was happening, looking at the stack of the usual suspects, the only things in the green basically were the inverse funds, silver, gold, treasuries. Everything else was red and horrible and getting weaker. So I felt pretty safe with the UVXY trade. Next up in that sequence was this is about half an hour later, and this just shows you what I've been experimenting with different screen layouts. What I wanted up top was a 20-day, 30-minute chart that uses the same RLCO lens, but then I also added a 300-period regression line, which is this other big, fat, bright blue, and it looked to me like I'm trying to see if that gives me any indication of longer-term, intermediate-term turning points. And I liked, from my short position, I liked the fact that it had fallen below that this other river, almost like an international boundary, that this failure here was more significant than the weakness from the highs, that this was really the beginning of a runaway downside move in SPY, theoretically down to 135. You can see here, now going from left to right, I have UVXY, SPY, and IWM, which I had been trading that morning, all on 3-minute charts. And you may recall I entered the UVXY trade at about 1390-ish, and now this is where it started running away up in here, and now price has moved up to about 14, almost 60. That orange is the price, 2-period exponential moving average of price, which for me is the price. And so it's up around 1556. Now I got 2R in hand, and it's just starting to run away from the river. You can see that now it's starting to leave the VWAP behind. When the Bollinger Band mean crosses above the VWAP, that's starting to be a really significant boost. You can see SPY has continued to fail. It's fallen another $1 from what we said, this failure to reverse back here around 138.20, and then it failed, made a new low of the day. It's also the time the frogs started kicking in, and now you've got all three regression lines and price outside of the river and failing. IWM has done the same. It's just starting to fail. So really, with 2R in hand at 1463, this is just beginning to be a potential runaway day, and it could be an additional 5 to 8%, another $1 in UVXY if the large caps and the small caps continue to fail. So I like the way this thing gets me started early, and then as things leave the river, it starts giving me additional confirmation. So I like that general strategy for trade management. I like that lens. Now later on that morning, this is about another 30 minutes later, price had moved all the way up to 1490 and now has started to roll over. You see the orange line has rolled over, the blue line, the 10-period regression, has rolled over. It crosses the 30-period regression line at about 1480, and so that's the time that if you're long, you've got to be exiting the position not later than price re-entering the river. So you get in about 1390, as we saw a few charts ago, and you're getting out about an hour later at about 1470-ish. So that's an 80-cent move on a $14 instrument, and that's about 8%. You've got to be able to make some money on those, I think. Now, after a really nice upward move like we just saw, and I see that regression line crossover, the next target really is the Bollinger Band mean. On this one, what I was looking at was I've been trying to figure out how to incorporate the VWAP into this, and with this geometrical mindset in mind, essentially what I look at is, well, when the regression line crossover occurs, a retest of the VWAP wouldn't surprise me. Later on we see that it actually did. So I look at that as a potential reward. And then what would invalidate that idea of a reversal here would be something that takes out the intraday high. And even if you just go to the regression line, the 10-period regression line, you see how it overshoots price a little bit. If you use that as your comfort margin to a new high of the day, you can see that the red line, the red vertical line, looks like your risk, and then this blue line here looks like your reward, and that's almost 3 to 1. And so that actually supports the idea of a trade from going short in volatility at the regression line crossover with a target back to the VWAP. And then, as we can see, that's actually what occurred. This is my my prototype ideas here. So when I actually, now we're going to look at SPY at about the same time. When I am looking at this rascal, what I see down here is it had sold off a down around 137 even, and then price and the 10 period and the 30 period regression line all met down here, and then starts crossing up. Price has gone into the river, the 10 period has gone into the river, the 30 period has gone into the river, the Bollinger Band mean is now starting to flatten out. Yeah, technically, could you enter at this regression line crossover? Sure. Could you wait until price gets in? Sure. The VWAP in this case is up here on this this vertical, the horizontal and diagonal purple line. What I like looking at is something like I think of it as the panda, and that is it makes a local bottom here. I expect it to get to the Bollinger Band mean, which it did, and even possibly to the far side of the river, pulls back, starts to go up again. Now, what I see is that it found support inside the river vicinity, the Bollinger Band mean. So that creates the second lower high. And now it comes back to test the top of the river, and now it's starting to leave the river. I actually prefer that kind of an entry rather than taking this regression line crossover after a significant downward move. Because in that significant downward move, I was making that 2R in UVXY on the other side. So I'm willing to let it fold this out. So even if you wait for it now to find support and then leave the river, look what you get. You still get an entry by this horizontal green line at 137.30-ish. But now you've actually had 3 periods of rising lows, found support, failure to fail further, and you still can have a tighter stop here. And look, the VWAP has not degraded that much. And if you just project this forward, let's say you got long here at 137.30, and you were targeting the VWAP, 3 things could happen. It could grind forward slowly, and it's going up while the VWAP is declining, and you meet it over here about 20 minutes later. Or you might find an intermediate move, or it might just suddenly shock you and just burst north, and now you've got you get to no lose, and you can pocket an R pretty quick. So I kind of look at these turning points through this kind of a lens, where the distance from the VWAP is of interest to me, the slope of the Bollinger Band. You see how it's started to roll over and get flat in here, and then the stalking entries after hypothetical lows of the day. This was a low right around lunchtime, so it's been selling off hard for about 3 hours, and now this could actually conceivably be the low of the day. And now a reversion to the mean, to me, looks like a reversion to the VWAP, and that looks like a tradable move using some combination of ready, fire, aim technique. Let's see, the last chart I want to show here is just daily on, this is UVXY. It's, it's identical to the VIX, it's just twice as volatile. And what you can see is that it, on a log scale here, it was up, at the peak of the last sell-off, around May, or late February, there was a little pullback. This thing was trading around 45. In the next leg up of the bull, it got down here as low as 12.5. So that's like a 75% loss in the value of that instrument. So like I said, no place for a nervous person. But on a daily basis, you can see it went from 12.5 to almost 22.5 on the last pullback, and then declined back to 12.5. It has found stability around 12.5 for the last week, and now the last 2 days, Thursday and Friday, have given us a pretty strong signal compared to, if you look at the rest of the year going back, the last time you saw 2 strong signals like that was here in early February, and it responded with an additional 25% move. And so I'm interested in the volatility play right here. It's been oversold for a long period of time and now just came out of that. And so a universal entry, to me, for intraday trading is definitely potential. I see a target of about 20, which And if you figure that's 5 points on a $15 instrument, that's a 33% move just to get back to the 50-period moving average. So that's why I've been a volatility trader here for the last couple weeks, and certainly the last 2 days. So VIX has given us a signal, I think, of a potential turning point in this aging bull. This is portfolio hedgers that are starting to get interested and itchy to preserve their profits of the last 4 months in this nice bull that's done so well for them, but which is running out of gas right at that key support level around 142. So I think the VIX is going to be an interesting play here going forward. Okay, so that's about everything from Kansas. I'll stick around for a couple minutes, but that's basically all the things I wanted to cover tonight. And I will have this recorded and hung. There was Mike observes that IYR looks a little better than most. Yeah, it's strong on a bunch of different measures, using the blended monthly rebalancing and the ETF2 approach, and then relative to the equities. You got to remember that real estate kind of often will move in tandem, or not in tandem with equities. So IYR does, in fact, look to be pretty interesting. I think that's for sector cycling or sector rebalancing. That's one that should be on your radar screen. Okay, so if there's no questions, I will go ahead and stop the recording and